Hello, so now I'm going to discuss some GST concepts. So before 2017, before 2017, there was no GST, and there were a myriad of indirect taxes, but GST came into effect in 2017 and it was a unifying tax. So you might have had excise duty, customs duty, sales tax, VAT, all of them were combined into one tax, and that was divided between the center and the states in a certain desired ratio, 50-50 ratio in fact. Now what happens is okay, let's understand the concept of GST. Let's consider an example. Let us say that there is a person 1, there's a person 2, and there's a person 3. Okay, this person 1 has made a certain commodity and wants to sell it to person 2 at a price of 100 rupees. Now he will have to add a GST percent. Say the GST is 10%. So therefore he is selling it at a price of rupees 110. Now this person 2 will make some processing in it and will add his own margin. Say he adds 110 plus 5 rupees, that is 115 rupees, plus a GST rate of say 15%. So this makes it maybe 115 plus 15%, say roughly 135 rupees. So he sells it to the person 3 for 135 rupees. Now the concept of GST is that it is a destination based tax, and therefore all the burden has to be borne by the final consumer, not by any of the intermediate consumers. So when this person sells it, he is not paying, he has to pay. See, whenever a person sells a commodity, he is the seller of the commodity and he has to file the GST returns. The buyer of the commodity does not have to file any GST return. So if I am selling a certain commodity, I am the seller, I have to file the GST return, I have to give the GST to the government. The purchaser doesn't have. If I go and purchase a television from the market, I don't have to see the amount of GST and give it to the government. That's a very important concept, and therefore this person is the seller. He is selling the commodity to person 2, so it is his duty to pay 10 rupees to the government, but he has managed to get 10 rupees within this 110 rupees. So he will pay that 10 rupees, he will not incur any loss. But the government will think that this person 2 is the final consumer, and therefore this person 2 will have to bear the brunt of this 10 rupees. But when the person 2 further sells it to the person 3 and files his own GST return, then he says that, see, I am person 2, I am the intermediate person, I am not the final consumer, and therefore I do not deserve to be bearing the final entire grunt of the GST. And therefore this 10 rupees, and okay, so 110 plus 5 rupees is 115 rupees, plus 15%, say about 20 rupees, is 135. So here the GST was 10 rupees, here the GST is 20 rupees. So it is the duty of this person 2 to pay 20 rupees to the government. But he says to the government, you have already received 10 rupees from the previous transaction from this person 1. You've already received 10 rupees from person 1, and therefore you should only receive an additional amount of 10 rupees, and that will make your 20 rupees. In other words, I will pay you 20 rupees, but refund me back the 10 rupees that was ultimately paid out of my pocket in this transaction. So when the person 2 files his GST return, he will pay 20 rupees and he will be given a credit which is known as an input tax credit of rupees 10 from the government. So this 10 rupees which was ultimately paid from the pocket of person 2 will finally be credited back to person 2, and the additional amount of 10 rupees will go to the government. In other words, in this transaction, the government gets 10 rupees. In this transaction, the government gets 20 minus 10 rupees, so another 10 rupees. So the GST of 20 rupees is credited to the consolidated fund of the government. Now, this person too doesn't pay anything from his pocket. He's got back the 10 rupees that he paid in this transaction. This person 3 is the one who should ultimately bear the grunt of this 20 rupees, because if this GST wouldn't have been there, then the price of this commodity, even taking this margin of this person 2, the price of this commodity may have been 115 rupees, but he is paying 135, and the 20 rupees extra is going from the pocket of person 3. So it is a destination based tax. Fair enough. Now you can see that in this transaction 10% is the interest rate of GST, not the interest rate, the GST rate, and in this transaction 15%, and only then this input tax credit is working, because the GST here is less, the GST here is more, 20 rupees and 10 rupees. Only then this difference of input tax credit is working. And if person 3 sells it to another person 4, the GST rate must be higher, say 20% or something like that. So this is called an upright tax structure. If the GST rate on the input or the raw materials, or what the person 2 is buying, is more than the GST rate on the second transaction, that becomes an inverted GST structure. So say this GST rate would have been 15% and this GST rate would have been 10%. In that case, the person 2 would have actually paid person 1 GST which is higher. Maybe he might have paid 15 rupees, and here he only gets 10 rupees. So he's paying the 10 rupees to the government. He's paying the 10 rupees to the government, but the government already has 15 rupees. You understand? So the government has to pay him 15 rupees. The government has to pay him 15 rupees, and the government is getting 10 rupees in return, because it is a destination based tax. Whatever is the last tax must go into the pocket of the government. In other words, it is an expenditure of the government. The government is paying 15 rupees to the second person and getting 10 rupees from the second person. In other words, it is depleting the consolidated fund of the government. This inverted tax structure, and talks in the recent GST Council was on rationalizing the rates because of the pre-GST rates, because earlier there was excise department, they were making their own rates, customs department, they were making their own rates, the sales tax department, they were making their own rates. So this sort of an inverted tax structure was present, but rationalization of that will ensure that the GST rate continuously increases. GST rate continuously increases down the supply chain. I repeat, the GST rate should continuously decrease down the supply chain in order to ensure that GST doesn't mean that the government starts paying the input tax rate more than what it receives to the people. Okay, this concept is clear, and now I want to talk about petroleum products. So there are important petroleum products like petrol, diesel, and air turbine fuel, which is used for aeroplanes. These are not included in GST. There are others such as kerosene, LPG, and etc., which are included in GST regime. So when they are included in GST regime, what happened is that initially in 2017, when these things were included in GST, their prices dropped, but the base price has increased ever since, and therefore the GST rate on that has also increased proportionately, and therefore their prices have increased. And in these items, we know commercial kerosene has a higher GST rate than domestic kerosene. Similarly, commercial LPG has a higher GST rate than domestic LPG. So this thing is known. But why GST is not being imposed on petrol, diesel, and ATF? Because what happens is that there is a base price. There is a price of the global crude, and then the refining margin and the dealership margin. You have the base price. On this base price, you add the central excise, because it is a production of these petroleum products. On that, in whichever state it is sold, the state imposes a state VAT. So this regime is continuing, and these rates are pretty high. If the base price is 50 rupees, these things are more than 50 rupees, so that the ultimate price of the petrol that you buy from the petrol pump per liter is more than 100 rupees. That's what is happening right now. So the thing is that, why is the price of petrol and diesel so high in this time of the second half of 2021? Because of three factors. Why is the price of petrol and diesel high? First factor is high global crude prices. So the global crude prices are of three types. One is called Brent, which is in the region of the North Sea. One is WTI, which is in the region of the Gulf of Mexico. And one is the Dubai or Oman, which is what India imports mainly. But the pricing of India is more or less based on the Brent. So you might have heard that during the COVID time, the price of crude went into the negative territory. That was for WTI, not for Brent. So it didn't affect India. But as the world has started recovering from COVID, we find that the global crude oil prices have risen, and right now it's about $80 per barrel. And because of this, the price of petrol that you buy in the petrol pump in India is more. That's the first thing. Second thing is the depreciation of the Indian rupee. So the Indian rupee, which was about 50-55 rupees for a dollar about 10 years back, is right now roughly 75 rupees per dollar, per US dollar right now. So this is also because of this. The global crude, which is $80 per barrel, roughly translates to rupees 6,000 per barrel, and India imports 5 million barrels per day, so you can imagine. The third reason are those taxes, which are pretty high. So it is a combination of these factors, and some critics are saying that even if petrol and diesel come into GST, still, just like kerosene and LPG, the base price can increase, and therefore the total price can also increase as years go by. But definitely the prices will drop, because if you put a GST right now, the GST will be more than 100%, and if it is 28% or 18%, that will ensure a huge loss of revenue for the center and state governments. So definitely there are a lot of factors which have to be taken into consideration before these high revenue products are brought into the GST regime. That's probably all that I wanted to discuss right now. Thank you.